Most people think banks make money because they invest well or manage money smartly. But the truth is simpler. Banks make billions because most people don't fully understand interest. When people hear 10% interest, they think it's small and manageable. What they don't realize is that banks earn more from confusion than from the number itself. Banks don't use simple interest, they use compounding. This means you pay interest on the original amount and then interest on the interest already added. Over time, the amount grows faster than most people expect. Borrowers think in months, banks think in years. That time gap is where banks make their biggest profits. Credit cards show a minimum payment that feels safe. People pay it and feel responsible. But most of that payment goes toward interest, not the actual loan. The debt stays alive and interest keeps adding up. The same happens with EMIs. People focus on what they can afford monthly, not the total amount they will pay. Longer loan tenure means lower EMI, but much higher total interest. Floating rates, repo-linked rates, and reset periods sound technical, so most people don't ask questions. When rates increase, EMIs rise, or loan tenure extends. Borrowers feel trapped, but banks earn more. On top of this, banks add processing fees, penalties, and annual charges. Each fee is small, but together they create huge profits. Missing even one payment leads to penalties and a lower credit score. Future loans become more expensive. Banks are not doing anything illegal. They are using knowledge to their advantage. When people don't understand interest, they stay in debt longer and pay more. When people understand interest, they pay faster and save money. Interest isn't the real problem. Not understanding it is.